following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Larry Pesavento.
Okay, we're starting the show, folks, with the Bradley model today because we are over the key dates. And we also have a possibility that we're going to be coming into a P-index date tomorrow, which is actually it's on the 23rd. That is one of the rarest of all things. It only happens 8 times in the last 300 years. Whether that's going to have much of an effect on the market or not, we'll have to wait and see. But since we're at historical levels here, it's really interesting to see what might happen. So the market has really done very little damage. As you can see, I posted a chart on the IWM, the Russell Index, and last week it stopped right at the 61% retracement. However, it was not able to rally like we were in the S&P and in the NASDAQ. That's the key thing to look at. But we really have I wanted to show one other chart before I get into the overall stock market things that I'm looking at here. But the long-term chart on the New York Stock Exchange Index has completed this major 5-point reverse wave, and this goes way back to 1974. It's also completing the ABCD from the 2009 low. So we're at a very critical level on this particular pattern, to make it look, very, very interesting from a spot where you would think that something really dramatic was going to happen. However, that's not the real stock market, and the real stock market is the New York Stock Exchange Index. When you look at it on a, oh dear, I hope I can find it. Oh boy. It's the trouble when you're Italian, you can't walk and chew gum at the same time. I think I have it here. Just give me 1 second here. If you have any questions, it's 877-927-6648. That's the number to call in if you have any questions. But I would like to show you this chart because it's very important, because we've made a head and shoulders pattern here. Last week, we haven't even come close to violating here in the New York Stock Exchange Index going back over the last month. And, we've made new highs in the NASDAQ. We've made new highs in the Dow. We have not done that in the S&P, nor have we done it in the Russell or any of these other smaller ones, but especially the New York Stock Exchange Index. And that is the best index to really look to see what stocks are really doing. What the promotional things are giving you on the TV is they're looking at the 500 Dow stocks, the 100 NASDAQ stocks, and let's go through the 500 S&P stocks, the 30 Dow stocks, and the 100 stocks of the steroid enhanced NASDAQ. So they're looking at basically 630 stocks of the more than 8,000 that are out there. Now the New York Stock Exchange Index is cap weighted, and it's the best 2,000 stocks on the New York Stock Exchange. These are the highest volatility, the best ones, AAA rated type stocks, no low price stuff that you get with the NASDAQ and some of the other things. So this is really what the market is doing. They don't trade this. They use it for calculations of ETS and stuff, but it is what the real market is doing. And as you can see, we've made lower highs ever since July 3rd. Now, this week is a very interesting week because if you go back and look at apparel, one of the things that I do look at, of course, as we've talked about on this show, is I go back to look in history to see when historic events occurred, because there's a lot of things that give us indications of what's happened in the past will happen again in the future. It's not every time, of course, but it's those few times when it does happen that gives you a huge edge. Well, in May of 1929, the market took off from a bottom at around 293 in the Dow. It went up to 383, around a 27% move in 99 trading days. That ended on September the 3rd. Well, we made a major bottom on April the 15th, and we've had a rally of about 7 or 8%, going up to new highs in the Dow Jones Industrial Average, and that date ends this week, right near this P-index date that we're looking at. Whether there's going to be a similarities there or not, I don't know, but the real key is if we would ever take out that April 15th low, that would tell us, yes, there is a great deal of symmetry of what's happened between 1929 and what's happening today. I really believe, folks, without any qualifications at all, that we are looking at something really, really nasty getting ready to happen to the stock market. As bullish as I was in 2009, I'm many more times bearish than I was bullish back in 2009 because this really looks terrible. I listened to someone on one of the financial channels over the weekend, and he said that his opinion was that the Federal Reserve has done what long-term capital did, and that is they became the market, and when it came time to try to unwind this stuff, they were unable to do that. So they made the same mistake, in his opinion, that long-term capital had done, and that makes sense to me too, because if you look at the Fed asset sheet, it looks like a flagpole, going from a roughly $500 million to $4 trillion over the last 4 or 5 years. And how are they going to unwind this, remains to be seen. We have to remember that the Federal Reserve is a bank for banks. They're not there to help us. They're not there to do anything else but to help the banks. And so remember that when you're, doing some of these operations that you're looking at in some of the things that we're trading. Now, I think that the biggest surprise here is going to be in the interest rate market. That's where I really believe we've got the biggest thing to look at as far as a potential of what could possibly be happening. Now, I'm going to start this out with looking at the banking index, because the banking index was also unable to make a new high, and we also have a head and shoulders pattern that is formed in the banking index also. So that's something that we want to, to see what the things will be, and we'll see what happens. And there's a question about whether the Fed can hold these to maturity. Well, certainly they can hold them to maturity, but the question is what's going to happen in between, because what happens if they start selling at a discount versus a premium? I don't know what's going to happen there. I just know this is something very, very sinister is happening in the markets, just looking at all these things, and it doesn't take a rocket scientist to figure out that when everybody's on one side of the market, there's going to be something really dramatic to happen to the other side. I don't think it has anything to do, with the types of things that we have going on with the rest of the news things about the Malaysian plane that was shot down. And believe me, I really believe that what we're hearing is not what the real truth is. My guess is the Ukrainians probably shot it down to blame it on Russia, just to get Russia off their back. That makes a good strategy for them to do something like that. Now, whether they did in fact do that, that remains to be seen. But that's one of the strategies that could be employed here to tell us that that's actually what really happened. Frankly, I think that the market that I'm watching the closest now is the interest rate market, and I'm using the 10-year note because we just completed some really interesting an interesting Gartley pattern on the downside here. And I believe that we're looking at higher interest rates coming in. We just made a perfect 61% retracement last Thursday and again on Friday. And we're going to see if the market is going to move to the downside and see higher interest rates. And we will wait and see if that's going to be the case. But it certainly appears that we do have higher interest rates coming by looking at the Treasury bonds and the Treasury bills. That's Treasury bonds and Treasury notes. Treasury bonds were interesting today because we took out the high of last week by just a tick or two, and then have since started to roll over a little bit, but that's still a little bit too early. But it looks like interest rates do want to go higher here, and I don't think they're going to go lower, but that's a question for what the markets are going to do in the near future. Now, the Dow Jones Transportations and the Dow Jones Utilities Both of those did not make new highs late in the week when we did with the S&P. So what we've done, with the Dow Jones. So we've still kept this three-drive pattern intact on the Dow Jones transportations. The Dow Jones utilities have been much weaker. They peaked well over 3.5 weeks ago and have had a little bit of a bounce back, but that also has been rather short-lived. And it doesn't look like the market has but believe me, with the reports coming out on Apple tomorrow, the NASDAQ could really have another move up, and that could pull some other stocks along with it, because it's one or two stocks is all it takes in these markets to seem to see the buying come in, and it's like a herd of penguins in the Antarctic, all coming together at the same time, feeding off the same types of news. Whether that's going to continue to do that or not, we have to wait and see, but that's my opinion. A question came up about, the fact that the Bradley model has been pointing for this up move here for the last few weeks, and it doesn't mean that it's going to turn from here. It's just a probability. What's interesting here is the turn doesn't really, turn back up again until sometime in December. So you're looking at a possibility of a 6-month trend coming at a time when we have all of these patterns are, coming to fruition and completing and stuff. So it's really, it's a very interesting phenomenon that we have going here all at the same time. So whether that's going to happen or not, we'll have to wait and see. The key price in the on the futures for the S&P 500 is the low we made last week. I've been saying that for several weeks, that 1943. We went down on Friday to 1942.75 and immediately reversed and almost went up and made a new high. We did make a new high in, I believe, the Dow Jones, but we did not do it in the others. But that's just because the market has different types of markets. Folks, the markets are different in context than they were 30 years ago, because we didn't have the NASDAQ until 1973. We didn't have the New York Stock Exchange Index until 1974. So in 1929, all we had was the Dow Jones Industrial Average and the transportations and utilities. We didn't have all these other things. So we have more information coming through, but the patterns are the same. I was doing a lot of work going back in history and looking at 1920s and 30s and 40s, and it's amazing. The patterns have not changed at all. The volatility is still there. There's just everything happening at the same time. I mean, nothing has really changed. They say it's different. Maybe it is, but it certainly doesn't look that way. When you look at the charts, they all look the same. And I don't think there's anything different this time. It looks the same like it was. I mean, if you looked at 1929, there was a big ABCD pattern that completed on September the 3rd, the high day, at 383. And then from there, the market went down to 42 in July. Okay, we got the Dow down 71 and NASDAQ down about 7.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Wouldn't it be great if you could get a red light, green light indicator that gives you signals on 25 different future contracts? Now you can with Taz Signal Box. This red light, green light market profile system dynamically updates 24 hours a day and provides you with important trend and trade signals on 9 different commodities, 9 different indices, and 8 different currencies. Right now, you can receive a free 2-week trial to Taz Signal Box. For all the details and to find out how the Signal Box works, visit the front page of TFNN.com.
Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, folks, we're back, and I wanted to spend a couple of minutes here talking to you about the crude oil market and also gasoline, because we're in the midst of the summer driving season, which is the most best demand for gasoline that we have. And I wanted to show you the crude oil chart, because we made a butterfly top back in last August up at the 112 level. We came all the way back down to 91, and then we went up to the exact 786 at 107 and change. And last week we came down and hit a 50% retracement when we hit $99 a barrel. That was an exact 50% retracement coming off the January lows, and what we're looking at now is we're almost at a 61% retracement back, coming in around the 104.40 level. We're trading at 104.15 right now. Well, what I wanted to show you here is, if you look at this for the last 6 days during this conflict that we've had in Russia, we have had virtually no rally in the gasoline futures at all. They've been down almost the whole month. They started down on June 23rd, and we finally have a slight update today. But as you can see from this chart, there's been a very, very strong sell-off in gasoline right in the midst of the strongest seasonal that this particular commodity has. It has I think it's a better than 75% chance of being up for the month of July, and as you can see, that is not happening. We were down, I think, 20 days, with only 2 days where you had a higher close during that whole time. So there's been a great deal of selling pressure coming into gasoline. And when you stop and think that the news was so very, very bullish to the crude oil on last Friday, when we had this problem with the Thursday with the airline, there was a huge rally of $4 a barrel in crude, and gasoline couldn't even get out of its way. It could hardly rally a penny. So that's really a very, very very strong thing to look at. So someone asked a question about the Pesavento date that we have, this P-index date that we have coming up on Wednesday is the P-index date. That's the 23rd. There's only one aspect on that particular date. That's only happened 8 times in the last 300 years. I don't know when those other 7 dates were. I got the information from my good friend Steve Rhodes, but it's going to be very, very interesting to watch. But remember, the last 2 P-index dates that we had in June, I believe 22nd and 23rd, neither one of those worked, which is very, very unusual when back-to-back indexes like that don't work. But, that's what happens. So it's going to be interesting. Whether that has anything to do with Apple, I don't believe so, because each of these is based on a different component. When we look at the P-index dates, that's based on the overall stock market. I don't have any indication that the P-index dates have anything to do with Apple. Not that they don't, it's just that I have not researched it. And because I don't trade Apple. I mean, I look at it because people have an interest in it and they ask me some questions occasionally, but I've only probably traded Apple maybe 4 or 5 times in the last several years. I did it when it was up around 700, and again when it was down around 390. I bought some puts and calls, but since that time I haven't really. I don't spend a lot of time with it because most of my work is done in foreign exchange and futures. And as you can imagine what's happening to our futures markets, we've got corn and wheat and soybeans down again, making all-time lows again. So they're still searching for some kind of bottom here, but we have a real debacle going on over in that grain market. There's some people over there that are really hurt, and not only that, but the open interest is telling you that there are more shorts coming into the market selling more. So that's even telling you that the market probably wants to go down to see see what's going on to the downside. We've had a good sell-off in the cattle and hogs, and that's also giving a little bit of a deflationary environment to their agriculture. But believe me, the corn and grain markets are a whole lot bigger than the cattle and hog markets. So those are the ones that you really, really want to keep an eye on to look at this. The main thing is that you have a big commodity like gasoline, which we all use, because just about everybody drives a car, and that tells us that we are looking at a situation where we have just lack of demand during the time when there should be really good demand for gasoline. Gasoline here in Tucson is only $3.19 a gallon. Okay, we got the Dow down 77 and the NASDAQ down 10.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and we're going to talk about the euro next, but I wanted to talk a little bit about history because July 20th of 1969 was a very big year. That's the year I believe they landed on the moon on July 20th. But something also significant happened that day. That was the day that Edward Kennedy and his girlfriend, Mary Jo Kopechne, drove into the water there in Chappaquiddick, and she lost her life. That went to page 5 on the New York Times because of what happened with the landing on the moon. And, of course, there was a big scandal afterwards, but it just shows you how the news can be swayed in different directions. We already know this, but this was a big time to really look at it. Also, yesterday was a rather sad day for me because I lost one of my favorite actors, James Gardner, who was in the Rockford Files, and was also in The Great Escape, and he was also Maverick. He was a really nice fellow, and when I worked at Drexel, I would go home on Pacific Coast Highway to Paradise Cove, where the trailer was, where they filmed the Rockford Files, and it was really fun to go in and watch the actors, and they were all very, very friendly, and if you got there around lunchtime, you could actually have lunch with them there, and it was really exciting, and it was really fun. He was a really nice fellow, and very, very friendly to everyone, and really a good person. So it was sad to see him pass on at the age of 86. Boy, I'll tell you, when you get to be up in my age, boy, the first thing you look at in the morning is the obituaries to make sure your name is there. And the key to that is to only look at the first edition to the paper. Don't look at the second edition of a newspaper if you get one in your town. Okay, the euro is at a real critical level here, coming in at the 134.40 level. We're trading at 135.20 and change right now. If we get below 134, it's going to break some long-term support here that could take the euro down to the 128 level without any trouble at all. That's something that is possibly in the cards that we're looking at. So we want to keep in mind that that's very important. It should hold a 134.40. But if it doesn't, then look out. We're looking at prices going, a whole lot lower in the euro, which means the dollar would be going higher, which means that if you're going to be traveling abroad, you're going to be having a really good chance to find some great values and stuff. Now we're going to take a look at the Japanese yen on a weekly basis. Because it has two patterns in here that are very interesting. If you'll notice in the top in 2007, we were making that three drive to a top pattern up around the 122 level in the Japanese yen. And that is very similar. In fact, it's exactly like the pattern that we have in the Dow Jones right now. It's exactly the same pattern. And whether that's going to be the same outcome that we have with the Dow Jones, I don't know, but it's exactly the same pattern. We came all the way down to 75. That's when Tom O'Brien became, bullish the dollar versus the yen, and we had a tremendous move up. And we've been at the 382 retracement of the major low that we had in 2013, down around 94, but we've not had a rally here. And that tells us that the yen is getting ready to go a great deal higher against the U.S. dollar. Now, if we take a look at the relationship between the Nikkei Dow and the Japanese yen, I think you're going to see something that is really quite interesting, and that is the fact that let me put this in so we can see it really closely here, and everybody will be able to see it. And that is that the yen, you'll see that the yen has been strengthening much stronger to the dollar than what the Nikkei is. That's telling us that the Nikkei is already heading down. We've had three lower tops in the Nikkei. When of course our market was going higher, we've had three lower tops in the Nikkei, coming in right around a 61% retracement of the whole move from last January. So for the last 7 months, all it's been able to do is make a 61% retracement. And so this is telling us that the Japanese market is weakening more than our market is, which in fact is what's happening. It's also telling us that the dollar-yen is actually weakening, so the dollar is weakening to the yen. We might get all the way back down to the old low was 94 of 2013. Well, we could easily, we're at 101 and change now, we could easily go down to the area of 85, and it would still be a bull market because the low was at 75. So you're going from 75 to 105, 85 back would just be a 61% retracement of the whole move. So this thing is rolling over. It hasn't, done complete rollover yet because we need it to close below the 100 level, par level in the dollar yen, and then we would have a much greater move to the downside. In my opinion, is what it looks like. What it looks like to me. So that's what I'm looking at with the dollar yen. The British pound, I believe, has already made a major top up in here at the 172 level. And the question is it going to be able to pop through the 172? But in fact, the pound is beginning to show a little bit of weakness every day now. And so I would think that the pound is getting ready to go back down into the 165 area from where it started its bigger move up. But it doesn't have the same impetus that we have with the dollar yen. This is the pound has been the strongest currency of the European group for quite some time now, and you would think with what's happening in Europe, that the euro would be weakening more and the pound would be strengthening more. But in fact, that is not happening. So this is why I try to look and see what the patterns are telling me and not listen to what the news is, because I don't believe the news is telling us what is really happening. And the reason for that is that it's all manipulated. I mean, we won't know. I mean, we didn't know what happened to the plane that they lost. And, with these beepers that they have on these planes, it's impossible, it's nearly impossible to lose a major plane like that. And I heard an interesting comment about Rolls-Royce engines that they use in these large jets, and they have their own sensors in these planes, so that Rolls-Royce actually is monitoring the things that they have that are in their planes, so that they can see what's happening at all times. So they know when something's wrong with the engines, that they can actually call the pilot and ask him, what problem are you having with it? Much like you have if you've got using OnStar with one of the General Motors products. I happen to drive a General Motors product, and if I have lower pressure in one of my tires, they tell me that. If I need oil, they tells me that. So they can do that, and with these beepers, they know where these planes are. Why don't we know? I mean, all of a sudden, that's never in the news anymore. That's another one of Malaysia Airlines problems. And, you have to ask, who's the beneficiary of this kind of stuff? I don't know what the answer to that is, but you have to go behind what's actually done in the world to see, why it's there. Maybe I'm too much of a paranoid person, but I'm really pretty positive. But it's really quite amazing to the fact that we don't hear anything about these things until many years later. And that's just my opinion. Just be careful of what you hear, because what you hear is not actually all the time, what it's meant to be. We've seen this many times in the past, that things have changed, quite a bit. So we'll have to let the rest of the world tell us what's going to happen with these particular things that happen in the world. Back to the stock market, someone asked a question about the VIX index. The VIX index did a really beautiful job. I think Basil Chapman handles the VIX index better than anybody I've ever met in this business, and I've been doing this a very long time. I'll give you a little synopsis of what it looks like to me. Whenever you get a market that has a VIX index, it can almost double in price in a matter of 2 days. It went from 1050 to almost 1550. It's telling us that somebody out there might be just a little bit concerned about fear, and we had a big sell-off that stopped at the 61% retracement, and so far today we've done very little to change anything. It's really not much happening, but the 61% retracement of the low from the low we had in the stock market back on April the 15th came in at 1,500 on the VIX index. So we know that is a very key level. So anytime we can get above 15, if we do, that's telling us that we're probably going to assault the area of the April lows. And boy, once we get below that, that's when it's going to get tough. We got a call from California. Brent, are you there?
I am, Larry. How are you doing today?
I am good, sir. What can I do for you? If we come up to the little break here, let me know, and I will we'll hold on. Okay?
Sure.
So what can I help you with?
I was calling about I use the UNG on natural gas. Okay. And my initial target on it was 21, which is getting close to, and that was based on a weekly 1-year chart. So I had the number I had was 1659 up at 2789.
Sure.
And then a 618 of that would put us around 21. So I just wanted to see if that.
That is that's a spot on Gartley here within about 20 cents from where it is right now. We had 3 lower tops, and let me put this into Tiger TV so everybody can see it. But it's a beautiful pattern because you had 3 lower tops, which the first one being in February, the second one being in April, and the last one we had in June. And each one of them was a perfect 786 retracement of the other market. You know what I mean? So that's what makes it interesting. I really think it's got a chance here to have a pretty good bounce, but it's come down very hard here. I'd wait a day or two just because of the weakness that we've had in, the gasoline futures. I know there's not anything connected between the two but it's just a little scary here because of the gap down. As you well know, because you follow this type of work that we do here with patterns, and a gap is one of the things that you're most scared of when you're doing this.
Yeah, I agree. Do you think there's a decent likelihood that it could do a 786 or even a 1-to-1? I mean, what's your...
I think it could very easily do. That's why I would wait a day or so. It's not going to change overnight, that's for sure. I don't think there'll be anything that's going to make it, well, maybe if the world... gets hit with some more war and stuff, the natural gas might move up. But frankly, I think you've got plenty of time to get in this. And the other thing is that it's the crude oil is also approaching the 61% retracement of that low we made at $99 a barrel. So that's another reason that I would take a look at it. One thing we should look at, Brent, if you have a second here, if you'll stay with me, is we should look at the natural gas contract, because that would be a good indicator of the problem is that some of these ETFs don't look anything like what the commodities look like. But we'll put it up here, and we'll see if we can take a look at it here. Just need to add some data here, and we'll be okay. And we should be all right here. But we're certainly in an area. See, this is much the natural gas contract is already at the very near the 786 retracement of the whole move. In fact, it's trading right there, right now. Wow, this is a good thing we looked at this. This would be something to look at your UNG, because if this holds right here, we're trading right at the 786 retracement of the market that we had back in. Way back in August. We're making a 786 retracement here at $3.83 per cubic foot here in the UNG. So I would think that that's what we're looking at. Let me see if I can get this chart put in here and let the folks see it, because we're right there right now. We left the gap down today, so the key there is to just wait and allow the thing to see if it's going to hold, and then you get a pretty good bounce out of it, because this natural gas is a very, very active contract.
Yes. So what would be a 1-to-1, Larry, if it doesn't hold 786?
Oh, you would be looking at $3.09 per cubic foot in the natural gas, and in the UNG you'd be looking probably around 16. 16 or 17, but you don't have to risk much here. What you don't want to get involved with is a massive gap. That's the scariest thing to look at, is if you get that. That's what you don't want to have happen.
And how much room do you give these Fibonacci's to?
Well, on something like we're looking at $21, I would give it 50 cents. Okay. Which is fair. That's about 2.5%. Because if it's going to work, it's going to work pretty well. Because you go back and look and see what it did in the past, and it's hit these numbers spot on. So you have to figure they're going to hit them spot on again, and that's why pattern recognition is so much fun, is because you can control your risk pretty good. The problem is that all the patterns don't work all the time, but nothing works all the time. So what you have to do is to try to find the ones that you can trade, which you don't have to risk very much. And this UNG, along with the natural gas, sets up a pretty good trading opportunity if it can hold these levels.
Yeah, it looked like a decent one. Well, I really appreciate your help, Larry. Thanks for looking at the natural gas. That helps a lot.
Okay, well, I hope it does. We'll see what happens. I'll be following it myself now after looking at both these together. This could be interesting. Okay, we're going to take a little break here, folks.
Thanks.
Dow still down about 70, NASDAQ down about 8.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy. A set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders, take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN.
Okay, we're back, folks, and one of our listeners asked me to take a quick look at a short-term view of the British pound, and I posted what's happened over the last several days. And as you can see, we just completed a bullish Gartley pattern here in the pound at the 170.50 level. We had a little bit of a rally off of that bottom so far, but that is a valid Gartley pattern. And of course, the Gartley pattern is where you have an ABCD coming in at a higher low. So that's the main thing. I did want to report a little bit about what happened at our meeting in Seattle. We went up to give a speech at the Market Technicians Association, and we had a really good crowd. In fact, it was standing room only, which was pretty nice. And what was really fun is I got to meet some of my old buddies from 40-some years ago, almost 50 years ago, that traded at Conti Commodities with me. And we got together, we chatted till about 1:30 in the morning, and it's amazing. We're still doing pretty much the same things that we were doing many years ago. They enjoy it just as much as I do, so it was really a lot of fun. What was interesting is we talked about the overall markets, and the three of us, I was the only one that was really skeptical about this bull market rally here. Both of them were on the side of the Federal Reserve, thinking they're in total control of everything, and that nothing is ever going to happen differently because of the Federal Reserve. And I frankly don't believe that, because I think they've made a very bad all-in bet, and they're going to have a difficult time getting out of it, much like what happened with long-term capital. I don't know how it's going to play itself out, but it's going to be interesting no matter what. Now, when we talked earlier in the show, we're in the midst of all this stuff that's going on with this plane and Russia, but I think even more important than that is what's happening, with Israel and the Palestinians in Gaza. That can be really, really nasty over a long period of time. So let's hope we can rectify some of these things, but they've been fighting for several thousand years, so I frankly don't think there's going to be much that they're going to do differently than what's happening right now, but we'll have to wait and see. I certainly believe that anybody that attacks you have the right to defend yourself, and I don't see how anybody can fault Israel for defending themselves, because they are very, very susceptible because they're so close, and these rockets come right in, and it's very, very nasty. It has nothing to do with the markets, but they do affect the markets because they go up and down on the news. That's why you see these $4 and $5 moves in oil. But remember, any market that can give you $4 on the upside can take $4 away from you on the downside. We've seen this a long time, so whether this is going to be the case or not. I think the key to watch with these markets are the currency markets. The dollar strengthening tells us that the interest rates are probably going to be going higher rather than lower, and that's another, here in the United States anyway, and that's going to be a very interesting thing to watch. One of the things that we've talked about on this show before was the ratio between the junk bonds and the U.S. Treasury bonds, and we've had a big change here over the last several weeks that we've talked about, and that is the fact that the bonds have started to, the junk bonds have started to lose dramatically to the 30-year Treasury bonds. That's part of the flight to quality theme that goes on, when you have these things happening, worldwide wars and stuff like that. People move to safe instruments like the Treasury bonds. Remember, Treasury bonds were selling at a discount to Spanish bonds. That's it, folks. Live every day in an attitude of gratitude and do a random act of kindness for someone today, a stranger. May God bless.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.